Hello, everybody. So much has been happening, and I thought a brief update would be helpful. As a reminder, back in mid-August, we made a bunch of changes to the portfolio. On the equity side, the two big things we did was we went to individual stocks and some ETFs, and we hold a bunch of cash. That portfolio is half in cash right now and half in individual stocks and ETFs. As a reminder, they tend to be high quality, which is a lot of profits and a clean balance sheet, meaning very little debt, and they tend to be essential to the functioning of our economy. So they're down since then, but not as much as the broader markets. And we're keeping a lot of extra cash to go shopping once there are signs that we've reached our permanent bottom. So we have not made many changes to that since August. On the other equity component, we did what's called the long short portfolio. So on that portfolio, we'll alternate between being short positions, which means that it's the opposite or it's the inverse of whatever the market's doing. If the market's going down, it'll go up. And if the market goes up, we'll go down. And long positions, which is what you're used to. You own Apple, and when Apple goes up, you go up. And when Apple goes down, you go down. So we use a number of different indicators for whether we should be long or short or neutral. In mid-August, it was clear that the market had overbought and that there was going to be an extended sell-off. And we were short over that period of time in this portfolio, and that worked out really well. Those positions made a lot of money. And then about 2 weeks ago, that indicator went neutral and we took the short positions off. We've added them back on, we took them off. And then yesterday we went long. The market has been very choppy. This portfolio doesn't work great when the market's choppy. It's more of a momentum portfolio. Whether it's up or down, it doesn't matter. We'll do well as long as it continues in one direction for a period of time. So you've seen a lot of trading going through. It's been a lot of work on our end, but we're following the indicators. We can't predict the future, but these indicators do give us a sense of momentum in the market. And on average, the market moves with momentum. It's kind of interesting why that happens. There's a few reasons. One is large institutions can't get in or out like you and I can, where we place a trade and we have as much as we want, or we get rid of as much as we want. Because they're so large, they have to grade in over time or grade out over time. Otherwise, they cause whipsaws in the market, and they'll probably get a call from the SEC to tell them to cut it out. So they have to take their time. And by taking their time, if they're buying, that causes the market to go up. And if they're selling, that causes the market to go down over time. So that's one. There's also technical reasons. People will cover their short positions, which causes a net buying in their algorithms start kicking off when certain levels are hit. People start buying call options, which is an option to buy the stock in the future. That's a net demand for stocks. So it's a supply and demand. But the bottom line is on that long short portfolio, we took half of the cash and went long. It won't work every time. To be clear, there'll be times when we buy and it goes down, and there'll be times when we're short and it goes up, and there'll be times when we're in cash and it goes up. There's nothing that works every time, but it does work over time, and that's the key. There's obviously no investment strategy that works every time. So those trades are there. In a bear market, which we're in, we have to just be extra active in the portfolio. Indexes in a bear market can go 10, 15, even 25 years in some cases where it goes nowhere. So our goal in this market is to make money. And the strategies we put in August are really designed to do that. As a reminder, the other ones, we have a bond portfolio that's buying individual bonds, and that's doing great. As those bonds mature, we'll buy new bonds, and they're mostly 3 and 6 months. We've gone out a little bit longer on some of them. We have bought some alternatives, just meaning it's not stocks, it's not bonds. We're going to have a webinar. We did one on private equity and private real estate, which got very good reviews. And then we're going to do another one on alternatives. The things that work well in the bear market don't work well in a bull market. And the things that work well in a bull market don't work well in a bear market. So over the course of last year and this year, we've been transitioning the portfolio to a bear market portfolio. So the number one thing that's on our mind right now is to preserve capital, full stop, and then to grow, to find growth opportunities. One thing I will say is the investors that are engaged in the process have, on average, a higher return than those that don't. So what I found in my own life is when I engage with my attorney or physician or accountant, we tend to get better results than if we just say, hey, would you do it for us? But when you engage with us, the brainstorming and the ideas and the engagement just allows us to make better decisions together. It's just a normal way that a working professionals. So our long-term thesis has not changed. They're just really challenging systemic problems in the market that are being driven by inflation, which causes interest rates to go up. And it causes PEs, price to earnings, to go down. So stocks will go down. And inflation also causes companies to have margin squeeze, meaning their expenses are going up faster than their sales, which causes their profits to go down. And that also causes stocks to go down. So we're not through this process yet. We've definitely not hit bottom. Stocks are on average still expensive based on the inflationary interest rate environment. And so in the long short portfolio, these are trades. These are not long-term long positions. When the indicator goes negative, we'll sell and then we'll short again. So that's what we're working hard at. We appreciate the opportunity to work on your accounts, and we're not going to leave any stone unturned. If you have any questions or thoughts, please let me know. I love hearing from you. Thanks.